Now we have Gurmeet Chadha also joining us from Complete Circle Investments. Gurmeet, here we meet again. Let's start our chat with power only because my colleague Prakash was talking about power. Gurmeet, you've been writing about power for some time. How are you playing it? Let's do it reverse. Why you like it? We'll discuss later. Tell me what all do you own in power? Because from legacy companies, wires and cable, transmission towers, financiers, there is a big bouquet out there in power.
Absolutely, Ajay. And as we were discussing in the morning, we are playing it through power generation, which is Tata Power. Also had some exposure to CG Power. Then you are playing it through the transmission space, which is Power Grid, and there's a proxy player to power through a company which is both into it's basically a defense company into explosives. Got the largest order from Coal India for 3,000 crores. Solar industry, the stock has done up quite well. 40% of the revenue comes from Coal India, which again is mainly on power generation. Also, some of the stocks are very valued, including Coal India, including NTPC. So that's one way. Then you have the renewable sources to play, which is Praj industry, that is more on biofuel, and that's more to do with also ethanol as well as the E20 blending and the plans they have on including biogas and eventual integration. The third way is to the financiers, and just see the move in REC and PFC, the way they have run up. I think the most long secular play, because others can be little tactical, is through the ancillaries in this space, which is cables and wires, transformers, insulators. So you look at polycabs of the world, you look at KI Industries, you look at Voltamp, which is into transformers. I think that's a more, because that's where there is, there will be good operating leverage, balance sheets are much better. Polycab, for example, the margins are now almost 14.5-15%. When we started in IPO, it was in single digit. So the company's really done well and probably will exceed 20,000 crore top line guidance, possibly next year itself.
Anisha, you'll be surprised to know Polycab at the time of IPO was doing profits of 700 odd crores annually. Now they do the same amount of profits quarterly. Look at where markets are slaves of earnings. Stock prices are the slaves. If earnings are there, nobody can stop stock from becoming a multi-bagger. So that is our view on power. What about financials? You had a very constructive view on a lot of NBFC stock. Did you trim them? Are you still holding them? People have got pretty kind of stirred, regarding NBFCs. But the numbers right now are showing some other picture.
No, so there is some, we have trimmed a little bit because the stocks ran up very quickly. So it's not that we have any fundamental negative view on it. And the RBI governor has been talking about potential stress which may come in the unsecured side. So only in NBFCs where the unsecured lending book is higher, and then the risk weight increased by RBI last week. Has some impact on CAR 1 and capital adequacy, which can have a very short-term marginal impact. I don't see anything structural. In fact, the stronger ones will get differentiated now. I think the bigger impact will come on the fintech lenders, some bit more on the even on the unlisted side. But stronger names like Poonawalla has corrected almost 20-25% from 450 levels. Bajaj has corrected more than 15% from top level. Chola, after a good run up, has seen some consolidation, and these are very richly valued. It's not that they are valued at a book value or below book value. So I think for short term, maybe the trade may shift to larger private banks because there is valuation comfort there. You have not seen HDFC at 2.2 book value for a long time. SBI is below almost 1 book value, hasn't done well at all. Some of the tier 2 banks, Federal Bank has the IPO now of its subsidiary coming up, which is FedFina, another bank which is showing good turnaround. So I think maybe for the short term, the focus may shift here, but I don't see anything changing as such. In fact, we'll be buyers in case any large correction happens. And I think one space which is within NBFC we like a lot is affordable housing. So we've been again lucky to get in very early into Home First.
But I just wanted to come back to the point that you guys were talking about in terms of power and power financiers. Take a look at the subscription figures coming in for IREDA. That's seen a subscription of almost 21 times already.
21 times?
Yes, 21 times.
By closing 30, 40 times perhaps.
Yeah, because I mean, the bulk of it comes in the last 2 to 3 hours,
Yeah,
right? So
yeah.
between 3 to 5 is when you will see that bulk of the money coming in, and it's already hit 21 times. There you have it on the screen. Tata Tech, it's been just 1.5, 2 days till now. It's already been subscribed 12 to 13 times, so massive amount of
Wow.
interest here. But your take, Gurmeet, on both of these, IPOs, Tata Tech and IREDA?
Extremely constructive on Tata Tech. I hope and pray, it doesn't get a very stellar listing so that, we can buy more on this. As it is, the IPO allotment will be less. So very constructive. In fact, I was fortunate to visit their site with my colleague Aditya in Pune. Amazing, capabilities they have developed. So, for beginners, they offer, end-to-end value chain on the automotive. So they're starting from concept, design, mechanical, which we call the hard floor model, to software embeddlement, and towards the end of the value chain. KPIT and XZ are more towards the software side. Secondly, they don't compete with OEMs. They help only in integrations. It's a pure service play. So, for example, they will not make autonomous driving ADS. They will help OEM integrate with it. As a result, they have a very highest on-site mix. In fact, it's more than KPIT actually. Third, they are capturing data. So these days vehicles have 70, 80 ECUs, electronic control units. And there's so much of data which can get captured, which can then be customized for client experience. So, for example, the tire pressure in high terrain, the heating requirement in winters, the fuel efficiency data. So going forward, I think this probably they will probably do what probably a Netflix or you subscribe for services in a car. So you take heating when you need heating in winters, for example, which is what BMW started and Merck has started in Europe, right? Huge, very good model. I saw some of the robotic stuff they are doing, live factory monitoring, and they call this as a digital cockpit in terms of what they do. So amazing capabilities, and probably this year we will do 750, 800 crores PAT. At the upper end, it's 20,000 crore market cap. So that's what, 25, 27 times. So I would just hope that, you get, even if at a 20% premium, I would probably be a buyer on listing.
Right. So that is about the new listings which are taking shape. The numbers are doing the talking. Gurmeet, autos. How are you playing autos? Is it more tilt towards auto ancillary, or you do have some big OEMs as well? Now the streets seem to be re-rating the two-wheeler OEMs. Bajaj, Hero, TVS, all of them are darting ahead. Even Eicher has come back after the pressure it saw from heightened competition talks, etc. How is that represented in your portfolio?
So very, very overweight, and I think that's played out very well for us. Tata Motors has played out very well, beautifully for us. So has M&M, despite the RBL concern. In fact, that's taken over. Numbers are still very good. I think the street is still worried on what they're going to do with the RBL, although it's a very small state. Two-wheelers, we don't have any OEM as such. We just had a holding company of TVS we bought as a special situation, which was Sundaram Clayton. Because there was a corporate demerger where it got split into three. You got an auto company, a holding company, and a preference share. So it was a tactical play for us. One thing which has really worked out well for us is both Uno Minda and Sandhar. Sandhar now recently last week, it's crossed 500 today, almost 7% up. It's from a one product, one OEM supplier. Now it's multi-product, multi-suppliers. Their two-wheeler revenue mix is now 55%. So they're market leaders in your locks and vision systems. They do a very good job on cabins for off-highway vehicles as well as CVs. They do a lot of fabrication work as well. And they're getting into smart locks, which is a very futuristic product, and building a nice EV portfolio. Companies now generated more cash flows in first half of the year than they generated the next year. So that should improve some debt equity ratios as well as overall return ratios as well. And Minda obviously has been an old favorite. I've seen the journey since 2016, and now suddenly the stock has really started showing a decent up move. Another one which we like is Sona BMW. So that's how we are playing this. M&M I think is due. So once the rural side picks up a little more, I think you should. It's still pretty reasonably valued compared to others.
Taken, but since we are talking about the entire auto sector, let me bring on board Shrishti. She's joining in to talk to us about that upgrade that we were discussing on Bajaj Auto from 5,400 thereabouts all the way to 6,200 plus. Shrishti, but what is the thesis?
Well, yes, a very positive note coming in from Morgan Stanley, where they have maintained the overweight rating on this particular counter with a target price of 60,229 rupees. After the recent move in this particular counter, they continue to stay bullish. And what they're highlighting is that the company is doing really great in terms of the demand, because the management is quite surprised with the demand that they have seen for some of the recent launches like Trime, and the festive season sales has been really good. Other than that, onto the supply chain constraints, they have been working well and looking to expand across categories. So let's dive deep into that. What Morgan Stanley is highlighting is that all the 5 cylinders are firing. First up, the Trime sales are ramping up better than they expected. The company is ramping up the production and the distribution of the Trime to 10,000 per month. That's the plan going forward. And they see a strong ramp up of Chetak EV segment as well. There too, the production was a constraint, and going forward, they plan to ramp up to 20,000 per month by the end of Q3. And not just that, they are coming up with new products in the Chetak EV segment. The new model launch of the Chetak is planned next month, so that is something to look forward to. The domestic bikes in the 125cc plus segment, that has done pretty well, not just on a YTD basis, but this festive season as well, that has seen a jump of almost 20% in the sales. Other than that, the three-wheeler business, that has maintained its leadership, market share of over 80%. And the three-wheeler business growing well through its focus on the CNG as well as EVs. And lastly, they are highlighting that the exports remain, is seeing a gradual move in the months, and the export is likely to reach 150 to 160k units per sales in the upcoming months. So all the 5 cylinders are firing for Bajaj Auto, and that's maybe what the investors are liking at this point in time.
Okay, point taken. So that's the view coming in on Bajaj Auto. But Gurmeet, what about the move that we are witnessing today on Honasa Consumer? Unwarranted or long overdue?
I think it was too much pessimism, during the IPO, long threads being written, why portfolio managers are buying. And I think that's why I keep saying that, the new age businesses require different lens. You may ignore it. I mean, and I'm mostly not an investor in some of them, but we should not comment on it. And these businesses have different growth models. I think the numbers were pretty good. It almost doubled, so doubled the better improvement on margin, doubled the PAT from 15 to almost 30 crores. In fact, the commentary on launching new products in beauty and personal care in the white space also helped the market. And then there was, brokerage reports. But, valuations are still extremely on the higher side. I would prefer to wait it out. But it's not that we don't like any new age business. It's just that you have to, as I said, have different lens for it and have a VC approach. You put 10 ideas and you be mentally prepared that maybe 6, 7, 8 will not go through, but the ones which go through will make up for that. And I think that's the approach needed to play this space. And but there was undue negativity around it. I think some bit of that is now getting reflected.
I do remember seeing all those posts as to why the mutual funds and the portfolio managers have subscribed to this one. Not sure if the verdict is out yet, but at least for today, the move is favorable. In fact, let's listen into what the management had to say, because they are quite confident of at least maintaining that 30% plus kind of growth rate.
Focused on masstige and mass premium categories. And I think as a business and as a house of brand, all our brands play in the mass premium, masstige categories. And this space is expected to grow at almost twice that of the mass segments in the country. I think given that and how the whole online, offline ecosystem is evolving, we are fairly uniquely positioned to capture this evolving opportunity in the beauty and personal care space. If you actually look at our capital efficiencies there, we've continued to maintain our working capital cycle. So I think our focus there will continue. The business, of course, is capital efficient, doesn't require that kind of a cash investments, in terms of how the channels are panning out for us. I think the focus is, clearly on delivering growth and delivering growth which is backed by a profit growth which is faster than top line, given where our margins are. And I think that will solve for itself. Our return ratios will continue to improve.
Sure. Kunal, a couple of these other buzzers as well. Of course, the entire sugar space is excited, but I see EID Parry moving on good amount of volume. So your pick from the sugar pack, and Prudent Corp, that's higher too by around 8 to 9%.
So for the sugar pack, I'll still stick to the larger cap names. So I think Balrampur Chini is something which I do track, very closely. That stock is looking attractive. There are, stronger other moves. I think I was looking at the charts for many of the other sugar names, Andhra Sugar and EID Paddy. I think there was a odd move. I think if I'm not wrong, from Praj Industries, which is sugar derivative of that. But I think many of these stocks have started to show signs of good price action. What I like about the chart specifically for many of these names is that many of these stocks are coming out of their seasonal kind of consolidation. So I think that's something to watch out for, because this could probably indicate that it may not be a short-lived trend, but it could short-lived rally, but it could be actually a trend in the making. Balrampur Chini specifically is something which I do track. I think that's a stock which I strongly believe could probably see a further upside. 550 approximately could be a near-term target range for Balrampur Chini. Prudent Corp, which you mentioned, I don't track, so I'll skip that.
Okay, but from the frontline index, it's HDFC Bank which is making a bit of a move. So just a 0.5% thereabouts, but given the kind of flattish performance we have seen from HDFC Bank, even 0.5% is something that manages to get us excited. But what's really exciting in the market right now is also the real estate pack, right? Gurmeet, how are you playing this entire real estate theme? Is it through building materials, cement names? Is there NCR that you like, or Mumbai, or is it just too expensive and stay away from all of these real estate?
No, not really. If you see, the high-end consumption has really done well. So if you see the luxury watchmakers, you see how the performance of the hotels have been, especially Indian hotels at the higher end. Look at the air travel data as well. So I think the urban affluent seems to be doing pretty well, and that's reflecting even in the real estate numbers. So the affluent units, the luxury units are doing well. So we like DLF. I think what they've demonstrated, they're getting the balance sheet discipline now. Did significant reduction in debt, did 15,000 crore pre-sales last year, guided another 18-20,000, and they have a lot of projects coming up. Command a very premium image in NCR market. The rental portfolio is doing well. It almost accrues 1,500 crores. Office occupancy rates are shaping up pretty okay for them. Some point of time they have a REIT also coming and some monetization which is due. But I agree with you. The bigger play, as I said, would be more in building material, because that's where you get better return ratios, better balance sheet, etc. So so we like Kajaria, we like Cera in sanitary ware. Cera, for example, 50% sales comes from tier 3 and above. Kajaria again, very big beneficiary of ban on Chinese dumping on Morbi tiles, etc. And moving to gasification of plants. So there's a tailwind supporting it as well, and there's a regulation supporting it. And even some of the cement names, after a long time seeing volume growth there, and you will see massive consolidation in this space. A lot of some small cement companies which are trading below replacement value, other than the larger ones doing well. I think that's where we are focusing more on.
Okay, point taken. In fact, since we are talking about the real estate sector and you talked about NCR region as well, so let me play a bite of the conversation we had with Max Estate Management and talk about what they are making of the market that we are seeing right now. Is it a bubble or is it a long-term trend?
When you look at longer term trajectory over next 5 years, if I only look at what we have acquired, which is 8 million square feet, the commercial portfolio, which today we have got 2 assets fully leased, giving us a rental revenue of 50 to 60 crores. This is going to reach 400 to 450 crores when existing commercial asset is at peak occupancy. So that's from a longer term trajectory. We are already looking at a baseline revenue over 5 years from 110 crores today at Max Estates level to 2,500, 2,700 crores. That's baseline based on what we have acquired today. And on top of it, we will continue to add a couple of million square feet, which will give us requisite growth for the investors beyond that steady state that I just talked about. Sticking to our aspiration of adding 1 + 1, approximately 2 million square feet raw material in the hopper every year, we are very confident of coming back and announcing to the market new acquisition over next 6 months. We are not eyeing for a large market share. We are eyeing for the indication and the guidance we have given. We are looking at 8 to 12% market share of the relevant target segment, the premium target segment, over next 3 to 5 years.
Okay, so that was the latest coming in from the management of Max Estates. But from the frontline index, Nuresh, it's Larsen and Toubro, which is down about 1%, and Infosys, which was showing a bit of a breakout yesterday and at the start of the trading session today, has completely given up its gains. Infosys in a reversal now? Nuresh, you'll have to unmute yourself.
Yeah, L&D came back to the highs made in October, and that is where it got a little bit of a resistance, but the overall trend remains positive. I expect 2900, 2950 to hold on here. So not really looking at it as a topping out case, but rather a case for consolidation. Infosys, on the other hand, tried to show some momentum yesterday. We are not seeing follow-up the next day today. So again, the same trend continues for a lot of heavyweights. We see one bit of say uptick, not a major follow-up next day, but the bias is still positive for Infosys till the time it holds above 1410 levels.
Actually, Gurmeet, we let you go. Thank you so much for making time. But I